We're going to talk about Chapter 12. The audit's over, you figured everything out, you just have to give your report. So there's a number of different ways we report out. So we're going to talk about each of these from the standard, unmodified, through other kinds of reports you might have to give depending on what you found on your audit. So we're almost done. We're reporting out. Alright, so this first video, we're going to go through kind of an overview. We'll go through unmodified reports, and we'll talk about reasons why you might not have an unmodified report. Alright, so there's a couple different kinds of reports that go with financial statements. So when your client files their financial statements at the SEC, right, public companies, they're filing their 10Ks. That's what we're auditing, basically. These financial statements that they report to the SEC. So as an auditor, we might report on non-public entities, or we'll report on public entities. Now, public entities reporting to the SEC, that's what I want to talk about. Right, so of course for any entity when you do an audit, right, you've reported on whether or not these financial statements are fairly presented. The financial statements and their related disclosure, so all the footnotes and everything that goes with them. Management discussion and analysis, that kind of thing. So that's for either public or non-public entity, you have to say these financial statements are fairly presented, or maybe they're not. And for a public entity, as the auditor, you also need to report on the effectiveness of their internal controls. All right, so that's what they call an integrated audit. That's why you had to test some internal controls in a public company. In a non-public company, you could have gone straight to substantive tests and just kind of said, well, we don't care if there's controls or not. We're just going to test and see if these numbers are right. But on a public company, you have to test some controls so you can say that the controls work or don't work. So you kind of have two reports. They're all kind of built in together. I think we looked at them at the first of the semester. It's just all kind of the same report. They look a lot alike. And management of your company, right? So when we say management, we mean of your client. So the CEO, CFO. The CEO and CFO say, we are reporting on our own internal control, and we say it's okay. So right, so we aren't doing this. This is what we do, the auditor stuff. Okay. So first we're going to talk about an unmodified opinion. All right. So a standard report, or what they call an unmodified opinion, in other words, just a regular old audit, and the financial statements are fairly presented, and that's it, you know, they're fairly presented, so we don't have anything really to say about them, so our report is no modifications, it's unmodified. So they'll all have an introductory paragraph, right, and in this introductory paragraph it just kind of says what you've done. Alright, so it's just an introduction. Okay, we're the auditors, and we audited these financial statements, the date of it, and the notes. This is what we did, a gas compliant audit. Okay, then we talk about, then the report will go on and talk about management's responsibility. So remember, you're the auditor. You're not responsible for what goes on at that company. You didn't even prepare the financial statements. You just audited them. So there's going to be a section out there that shows that you are not responsible for what management is. Management is responsible for them, right? For the preparation and fair presentation in accordance with GAAP or maybe IFRS or whatever framework this company uses. A foreign reporting company can report under IFRS on their 20F. They don't have to use US GAAP to report to the SEC. So, whatever framework you're using, typically for us in this class, we're always thinking of US GAAP. So management has to do that. Management creates the internal controls. Management is responsible. So there's always this, and these all look the same. Like if you'll go out and go out to Edgar or somewhere and pull up some 10Ks and look at the auditor's reports, you'll see they all look the same. And if you look at the same ones from the same company, they're just flat out boilerplate, they look the same. Next will be the auditor's responsibility. So you'll see what the auditor is responsible for. And we are responsible to express our opinion. We're responsible to audit using GAS. We audit according to generally accepted audit standards, right? And we talk a little bit about what an audit involves. It uses our judgment. We consider internal controls, but we're not the ones who design the internal, right? It's kind of like trying to get people to go like, look, we went in and we looked at stuff, but we didn't prepare this. We aren't the ones in charge of internal control, right? And we believe the audit that we've done is appropriate, and it gives us a basis for our opinion. And that's another important thing, our opinion. It's not a guarantee, right? We're saying based on our judgment, this is what we think. Okay, and then we have the opinion, right? And that's just like you would expect. In our opinion, remember, this is an unmodified report, right? So there's nothing wrong, right? So in an unmodified report, you go straight to the opinion, and it says these financial statements present fairly, right? They're not 100% accurate, but it's a fair presentation, right? Because it's impossible. Plus, just think about financial statements. They're rounded off into millions, right? So they're not exact, perfect financial statements. They're fair presentation. And the date, and according to GAAP or IFRS or whatever the framework is, right? And it's in all material respects. So I want to point that out too, right? So material respects. There could be a little error or something that is not reflected in these financial statements, but it's not anything material. All right, so the unmodified report always includes, and you'll see it at the top of the report of the independent auditors. That's like the first line, right? Addressed to clients. Normally, the people who've hired you are the shareholders and the board, right? Not the CEO, not the CFO, but the board of directors. It'll be dated as of the auditor's report, right? So we talked about that in chapter 11. That's the date you quit looking for stuff, right? I'm done, going to write my report and go. So that's the date. And it'll be signed by the firm, and it'll have the firm's office. So if it's being audited by Ernst & Young out of San Antonio, it'll say the Ernst & Young office, and it'll say San Antonio. It won't say like which specific auditors did the audit. It will say Ernst & Young, and it will say the office, San Antonio, Austin, whichever one did it. All right. So that's a report. If there's an unmodified opinion, that's it. You've said these financial statements are fairly presented in all material respects according to GAAP. Unmodified opinion. Everything's go on about your business, right? But there's some other things that could happen, all right? And one is a qualified opinion. So that means they're fairly presented in all material respects, except for like this one thing. We need to tell you about it, all right? So something is not in accordance with GAAP, right? But the financial statements are mostly okay, just this one thing, right? So that's what we call a qualified opinion. An adverse opinion is something, interestingly, you will never see because, well, you can't file financial statements that contain material misstatements. So an adverse opinion means you, the auditor, decided these financial statements are not fairly presented. There are material misstatements, and not just one little exception like in a qualified. It's like these are bad financial statements. So the reason you never see that is because, well, you can't file them. Nobody will accept them. So it's not like it's not like you go to the SEC and say, well, it's the due date for our financial statements. Here they are. They're misstated. That doesn't happen. So you won't really see them, but you might give one as an auditor, and then they would have to go redo their financial statements and get somebody else to audit them and stuff like that. There's also a disclaimer. So once in a while, as an auditor, you'll do an audit or it's more likely you get partway along an audit, and you just have no opinion. You're not saying they're fairly presented. You're not saying there's a material misstatement. You're saying nothing. Typically that happens when an auditor starts an audit and then they find out they're not independent. Like, oh, this partner in the office owns stock, or this partner's wife owns stock in the company. We can't audit them, right? So you just stop and say we have no opinion. You could come to the end of an audit and have a scope limitation so big that you go, well, everything might be fine, but we can't tell, so we're just going to have no opinion. So those are some other types of opinions you could have, and we're going to talk about some of that stuff on the next video.